On the strength of strong global crude prices, Oil India reports excellent results for Q1 of FY23. From 1st July 2022, government introduces windfall tax to protect interests of domestic customers and also to raise revenue for the central government. Oil India is India's second largest hydrocarbon explorer and producer. It is also known for transportation of crude oil and production of liquid petroleum. Although its operations are spread out across the country, its activities are significantly in the northeastern part of the country, and it has a sizable overseas portfolio comprising 17 blocks spread over 10 countries. Oil India, one of the strong public sector units, where central government holds 56.7%. Mutual funds during last 12 months have reduced their stake to 3.3%. But the positive thing is FPIs have raised their stake from 8.5 to 12.4% during the same period. DIs have sizable stake, retail and others, around 15.4%. A strong shareholding pattern with a specific mention of FPI holding. Taking the performance for June 22 quarter and comparing it with the previous 2 years, June 20 crude from 51.8 lakh barrels, it fell down to 51 lakh barrels in June 21, but there is a growth of around 6% in June 22. But when it comes to natural gas, in terms of lakh MMBTU, June 20 to June 21, there was a sizable increase, but from June 21 to June 22, there is a negative growth, and that way the overall increase in quantity or volume is quite minimal. For revenue and EBITDA, June 22 quarter has been quite special as a leap quarter. Revenue growth is substantial. Between June 20 and June 21, there was a growth of about 45%, but current year's growth is closer to 85% over June 21. Similarly, EBITDA percentage has moved from 18.5 to 34.8 between June 20 and June 21, and now it has reached a peak of 42.2. That is being very positive. The real push has come from higher realization made during the quarter. Crude, which is behind a major part of its sales, has given a growth from $30.4 to $67.2 up to June 21, and from there it has given a growth of over 67% to $112.7 during the current year June quarter. And natural gas has also given a substantial growth, more particularly from June 21 1.79 going up almost to 3 times, and the higher realization was caused by the Ukraine crisis and demand concerns across the globe on crude and related products. Noting the excessive realization causing abnormal profits, central government has taken it as a revenue mobilization drive and also to protect domestic demand of customers with an windfall gains tax from 1st July 2022. The tax will be reviewed every fortnight depending on prevailing global crude prices. And the restrictions on exports of petrol and diesel and aviation fuel has also been introduced to secure supplies against domestic demand. With the tax mechanism in place, the likelihood of any abnormal gains to Oil India as an E&P player looks quite remote in the very near future. The quarterly results of Oil India were announced on 10th August 2022, but surprisingly from 10th June 22 onwards, till the announcement of results and after, the share price had a big collapse, falling regularly, and this fall was mainly due to the Brent crude price prevailing at the period, as Oil India was closely following the price trend of Brent crude across the globe. The collapse of share price post 10th June is quite widespread, and the falling share price has taken the price to a level where it was before March 2017. A period of 5 years after that, bringing the share price to 191, leads one to believe that Oil India gives good dividend, but market appreciation wise it is quite disappointing. The force behind the share price collapse of Oil India is quite clear and evident when we have a look at the share price chart of Brent Crude. On 8th June it was 123 and it collapsed to $92 on 16th August on fears of recession in US and in the European Union, as also because of the falling demand in China. The strong correlation of Brent crude and the share price of ONGC and Oil India is quite forceful and is direct. A look at the chart of three entities together, Brent, ONGC and Oil India, makes one thing clear, that right from June 2022 till date, it is Brent which leads the way and its close followers have been ONGC and Oil India, with Oil India being a laggard for most of the time. I am Vittal Prabhu with a weekly video on Stock Learning Simplified. Hope you will find the video educative and interesting. Oil India Limited has got a very strong track record, particularly during the last 5 years. Its revenue grew from 9,566 to 30,011, yielding an impressive 5-year CAGR of 25.7%. And its last 1 year achievement has been an annual growth rate of 33.5% ahead of 5-year CAGR. Similarly, its EBITDA moved from 3,120 to 10,500 with a 5-year CAGR of 27.5%, and the annual growth rate was quite unbelievable, moving from 5,688 to 10,500, 84.6% of annual growth. Similarly, growth was visible in profit after tax with a 5-year CAGR of 33.3% and annual growth of 62.1%. With all this, what stays behind is the massive growth of EBITDA during the period, supported by increasing realization per unit. Three things stand out in the cash flow of Oil India. Operating cash flow, recent financial year growing up to 10,701. Nominal working capital movements, consistent dividend, and a strong operational surplus helping plow back almost 8,000 crores in the recent year. And another unique feature of fixed assets investment closer to 6,000 crores in the recent year. Operational cash flow, operational surplus and fixed assets reflect the total strength of Oil India. Special about Oil India is its reasonable payout. During the last 6 years, in relation to its payout, the dividend amount has maintained a relation of regularity. Payout has ranged between 86% and 23%, but the median value is well above 20%. And what is significant is the yield in relation to market price, which is well above 7% on a long-term basis, and that is the reason for investment interest. Deeply discounted price earning multiple is a disappointing feature of Oil India. Its market cap has fallen from the 2017 level of 27,000 crores to 21,000 crores. Not a happy growth. But company's PAT has kept its growth in action, and based on the price that the company enjoyed at various points in time. Disappointment is its PE multiple has been consistently falling in spite of good performance, and the PE multiple of 3.1 is almost at a discount of 30% to the median value of 4.8. And the main reason behind this appears to be the government intervention with windfall gains tax and other restrictions that has kept the PE subdued and under strong check. Hope this video on Oil India Limited was to your liking. You can access similar videos at our info card on Stock Learning Simplified. We look forward to your likes, shares and comments. If you are new to the channel, may please subscribe and press the bell icon for timely intimation on our forthcoming videos. For your valuable time, support and interest, highly obliged. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, please seek the advice of a competent professional before taking action of any kind.